Thank you so much for joining me once again. My name is Olaibiwoye. I am the host and founder of Commercial Property Club podcast. Like I always said, we bring valuable knowledge when it comes to income producing properties, apartments, senior living, retail, medical building, as well as warehouses. We bring on board experts, people that are participating in the industry, to share their experiences, the valuable experiences are quality. You really can invest wisely unless you have knowledge when it comes to income producing property. That's why we come with professionals as an expert. Today, I have somebody that is an expert in the mortgage advisory aspect of things. Today is not new to financing products in the income producing property aspect of things of commercial real estate. Today I have with me Beau Eckstein. I will dive into his biography a little bit before we start the show fully, so stay tuned. Beau Eckstein has been in the industry for the last 20 years. He's done financing in residential as well as commercial financing. He's done quite a bit of business consulting also too. He's licensed in the aspect of real estate brokering in California. Operates consulting company that helps businesses own and grow their businesses and provide commercial mortgage advisory services. Just like I said, that's where we're going to dive in today. Beau has a large network of bank, non-bank lending partners also to those who, partner with him in order to run his business fully vertically. Beau has divisions which work with business owners also to help reduce operating expenses and improve efficiency, also how to retain valuable employees also too. Beau has clients all over from construction companies to property management companies, real estate companies that are involved in hospitalities, amongst so many other businesses out there. Beau works with new established business owners. Also too, in the aspect of what we're talking about today, Beau is a big player when it comes to working with the real estate investors also too. Whether you're starting freshly or you are willing to expand your business, Beau is on board to work with you in strategic financing and also optimizing your services. Beau has 3 companies that I'm going to name them one by one right now that, like I said, works with him vertically to discharge great and wonderful services. He has an emerging lending group. He has an emerging franchise group, and also what he calls expense savvy. He's going to talk elaborately about some of all his service today, particularly the aspect of mortgage advisory today. So without no further delay, I would formally introduce to you Beau Eckstein. Say hello to my viewers, Beau.
Hello, thank you for the great introduction. Appreciate it. Glad to be here.
Awesome. So we talked about mortgage advisory, and today we know you, with your experience, you bring valuable knowledge on board today. So I am going to ask you, how did you get into real estate financing, the mortgage advisories of things?
I always knew I wanted to be in real estate, and I just happened to, I didn't go to college. Yeah, I always knew I either wanted to be like in law enforcement, I wanted to be a detective, or I wanted to be in real estate. And I ended up just starting my career at 20 years old, working in the sales department of a mortgage company, residential mortgage company. And then just continued. As I got older, I realized I'd like to learn. So I started teaching myself and learning from others on all facets of financing. And then I got into investing. And once you become an investor, then you learn about creative financing. So I put it all together to really, be able to provide value to people that want to work with me, right? I get people that are first time investors that want to buy a single family home and rent it out as a short term or midterm rental. I got seasoned investors that buy $50 million buildings. So it just depends. I can help most any business owner or real estate investor when it comes to strategic financing.
Awesome. Isn't it amazing to have that foundational desire to go into a certain field and you just make it happen for you at all costs, which was what you did. You just wanted to be in real estate and you find yourself a mortgage company to work with, huh?
Yeah, pretty much. It's, there's a lot of opportunities out there, and it's just, what I sell is money, and people need money to finance their business growth, to start a business, to buy an existing business. And as you get more seasoned in this, just as a real estate investor gets more seasoned in acquiring real estate, you figure out how to structure deals and make things work. And then you solve problems. Like just before we went live, I was talking to a good friend of mine who's got involved in a deal that went sideways on a 112 unit building. So he needs some bridge financing right now to get out of the trouble he's in. It wasn't his fault. It was the GP of the deal just totally screwed it up. So I got to come in and navigate and, put in a little over $3.5 million of bridge financing so they can stabilize the property. So whether it's an acquisition, it's a mid-construction project, there's always a way of figuring out how to get things done. Most things are financeable. So it's just a matter of getting the right fund or bank or credit union on board to provide the financing.
Talking about that, being able to structure financing. So take us through about the nature and the cycle of a real estate finance.
Sure. So on a purchase transaction, I get a lot of calls, a lot of booked appointments where people are like, hey, I'm looking to acquire, let's say, multifamily property. And they go, well, I need to get pre-qualified. Well, really, it's not about you being pre-qualified in the beginning. It's about the property being pre-qualified, the cash flow. Are you buying a stabilized asset? Meaning, is it 90+% occupied? Or are you buying something that is 70% occupied and it needs to be renovated? It needs a lot of CapEx. Mm-hmm. So we start with the property. And then when we're figuring out, well, okay, it's a stabilized property. It's running well. Occupancy's there. It's in a good, strong market. Then we go into the sponsor's background. Does the sponsor qualify for agency debt? Agency debt, typically you need to have experience owning and operating similar type of multifamily units. So you need experience. You need net worth equal to or greater than the loan amount for agency qualifications. And this could be anybody on the GP side. You might have 2 or 3 sponsors. And then you need to have at least 10% post-close liquidity for a stabilized asset. In that case, you can do agency debt, which is Fannie Mae or Freddie Mac. And then based on where it is, location, the sponsors, Freddie might make more sense or Fannie might make more sense for the deal. Okay. And then we take it out to the market through our agency partners, and then we get pricing and we quote the deal out. Now, if it's a bridge loan, meaning it's not stabilized, then we look for the right bridge lender, and we're going to kind of look at the same stuff. Is it a heavy lift? Does it need $2 million of capex and it's a $2 million acquisition, or is it a light capex and it just needs to be managed properly? And then from there, what's the total project cost? What's the total loan amount? And there's different buckets. There's bridge lenders that specialize in loans $2 million and less. 2 to 5 or 2 to 7 million, and then the big bridge lenders that they want to do only deals that are 10 to $80 million type of transactions. So you got to find what bridge lender to do the certain aspect, and also leverage. Some bridge lenders are lower leverage but better rates. Then there's some more aggressive bridge lenders that will do 85% of purchase price and 85% of capex, so 85% of total project costs. It's pretty aggressive, right? So the sponsorship team needs to bring in or raise 15% of total project costs for something like that. So there's all different buckets of lenders. And then, of course, if it's a stabilized property and you don't meet agency qualifications and you can't put the team together, then that's when we take you out to the bank and credit union markets. So we have a platform where we have a couple hundred banks and credit unions nationally. So we put the deal on the platform and then we get multiple quotes for our borrowers. So we've streamlined the process. Before, I had a client, let's just say he didn't meet the requirements of agency debt because he didn't have the experience, but he was buying a 20-unit property in Tennessee. The property, the cash flow was there, the DSCR, the debt service coverage ratio, everything was there except the experience. So I was able to find a local credit union in the market, close the deal at better terms with the credit union than actual agency debt. Now, the downside of the deal was the amortization wasn't 30, it was 25. There was no prepayment penalty, which was an advantage. So a lot of times, agency isn't the best because they have usually a 5-year prepayment or yield maintenance agreement in place. So we look at the deal, we look at, is it going to be a quick turn? Are you going to look to do a cash out refi in a few years? So we want to make sure we know what bucket to put the deal in. And is it a bridge deal? Could it potentially be a HUD deal, which is another bucket, right? And so there's all these buckets. So what we do as commercial mortgage advisors is really assess this quickly. We're asking these qualifying questions. We're getting copies of the trailing 12-month profit and loss statement, rent roll, a little bit about the CapEx work they're going to be doing, and then sponsor's resume. What other buildings do you own? That kind of stuff. And then obviously a PFS for each of the sponsors, which is a personal financial statement.
Awesome. You've actually really broken it down quite, talking about agency debt and some other aspects of buckets, like you call it. I have questions down the road, but before I get to that, you talked about somebody right now that probably just started with 20 units, and sometimes. What are they getting into? How do you source for real estate financing as an investor in the process of buying probably maybe as much as 100-unit building apartment?
How do you go about sourcing the debt? Well, my advice would be to talk to somebody like me, whether it's me or somebody that works at a big, capital advisory firm, and tell them what you're looking to do and what kind of asset you're looking for. And as the sponsor, when you're going to do this, just know typically we're going to want a T12, trailing 12-month P&L, rent roll, offering memorandum if there is one on the property, or marketing brochure. And then we're going to need the sponsorship information. Once we have those few documents, we can quickly assess what makes the most sense for this deal, on this 100-unit deal. Is it stabilized? Is it, are they doing, is it, a 1970s and it needs full improvements, and then we're going to do a heavy CapEx, interior remodels and stuff. And then that's when we assess, okay, maybe a bridge to agency product. So there's agency lenders that also, they offer what we call bridge to agency. So they do they underwrite from an agency perspective, and they also provide the bridge financing. So that's like an all-in-one. The downside of a bridge to agency lender is they scrutinize a little bit more than the typical just standalone bridge lender. So we look at all those aspects, but really it just starts with a conversation, to be honest with you. This is what we're looking to do. And it's just you and I having a conversation about the asset you're looking at, and then it gives me time to assess and give you some kind of initial feedback on the deal and what I think might be the best route to finance it.
Awesome. So typically they just need to put a package together, like the P&L, the location of the property, so that you can assess what works. Yeah.
It's really simple. It's in the beginning, just getting the financials of the building or the property, and then, a little bit about the sponsorship team. And then you can quickly assess what kind of deal this is going to be. It's going to be agency or not. Is it going to be a bank or credit union deal? Sometimes on syndication deals, the way they structure all the operating agreements and stuff, some banks and credit unions don't like the syndication model. So you just got to know how to navigate the particular, how the capital is being raised, and the current in place debt coverage, and then what the stabilized value is going to look like. So on high leverage bridge financing, for example, they can do as high as 85% of the acquisition price and 85% of the CapEx. Okay, they usually say we can lend as high as that, so you only need to bring in 15% of the total project cost. However, they're going to get an MAI appraisal, which is just a commercial appraisal, and they're going to appraise it as is, what the as is value today is, and then what is the stabilized value. And as long as the total gross loan amount is less than 70% of the stabilized value, what it's going to be worth when it's stabilized, then we could do 85, which is very high leverage. And then, oftentimes I might be the general partner on this acquisition, but you're bringing in, somebody that owns less than 20% that's going to maybe bring in the equity into the deal. So it could be a JV, it could be a syndication. It doesn't necessarily have to be a syndication, right? Because you can just have JV partners, joint venture partners.
Joint venture.
So it's all, yeah. So looking at all these pieces really assess how we're going to finance it, what's going to work, what won't work.
Okay. Awesome. Talking about secondary mortgage markets, like the agency loan you're talking about, Fannie Mae and Freddie Mac. Can you explain roles in today's apartment financing? Can you break it down much more on today's when you look at today's financing?
Yeah, really. So we talked about the general qualifications. If your sponsorship team meets those general qualifications, the advantages of Freddie versus Fannie, it depends. Freddie seems to be a little bit more aggressive at some points. And then also, what is the plan of the property? What's Freddie Mac has more of a kind of they call it the Freddie Mac floater program where you can only get a 1-year prepayment penalty. So you can almost use it like a bridge product. So depending on the scenario, we dive into that. But really, the agency lenders, they typically have regional offices, and there's a certain amount of direct licensed, let's call them banks or let's call them agency lenders. There's a certain amount of licensed agency lenders, which isn't that many. I believe it's, don't hold me to this, it's somewhere around 20, 21. And they're direct agency lenders, right? And so most, if you're like me, what you do is you work with the wholesale division of these different agency lenders. So we know when we get a deal, we're looking, does it make more sense? Is the property contiguous? So sometimes we'll get, it might be a couple buildings. It could be a portfolio of 3 or 4 different multifamily properties. So that's all going to play in. And is it affordable housing? Is there any covenants on the property? So those are the things that might make sense to go Fannie or Freddie based on those scenarios. It's really deal specific, which might be a better fit.
Deal specific.
But really, the other thing is the market itself. Is it a larger MSA or is it more of a tertiary market? And when we say tertiary market, that means it's more of like a bedroom community, right? It's only got a population of 25 or 35,000 people. It's not a very big city. And then also, these lenders all have different tastes in their mouth about different locations, right? Some markets, they might have had a deal that went sideways in the tertiary market. So that lender is not going to be interested in that market. A lot of times in these smaller tertiary markets, it's hard to find comparable sales because there's not too many 50 or 100 unit buildings in this market, right? And so these are all the things that we have to worry about. And that's why sometimes, even though you have the experience, that agency debt might not be the best. And we might take it to a local credit union or bank for the fact that they know the market. And it's, they like the small community because that's where their bank is, their credit union is. And so sometimes that's the difference. Also, sometimes I like to go credit union debt instead because it doesn't have prepayment penalties, right? And so instead of being trapped into a deal for 5 years, and when you're paying yield maintenance and all of a sudden year 3, there's a big uptick in appreciation, you forced a lot of value into the building, and now you want to refinance, but your prepayment penalties, several $100,000. So That's why we look at the full equation. Now, agency debt is non-recourse. So a lot of syndicators who are raising big amounts of money, they don't want to personally guarantee. Now there are what we call bad boy carve-outs, meaning if there's certain frauds committed or whatever, it's going to be recourse debt. But all in all, agency debt is non-recourse. Same thing with HUD debt; it's non-recourse debt. So that's why a lot of the bigger sponsors want to go agency, because it's amortized over 30 years. It's non-recourse.
Yeah,
if that makes sense.
Yeah, awesome. Looking at your biography, which you already even alluded to, your network of connection when it comes to lending, private partners as well as institutional partners also too. What other source of fundings, both maybe institutional or non-institutional, is available to finance apartment projects that maybe out there that we want to talk about?
Sure. So it's really, there's some USDA products for rural properties.
Okay.
So if it's in an area where the population is less than 50,000 and it's designated rural, you can do some USDA. I don't do a lot of USDA, but it is available. You have obviously Freddie and Fannie agency. You have HUD, and you have bank, credit union, debt, and then you have all sorts of various forms of bridge debt. And then you have pref equity, which is preferred equity, which goes in the capital stack.
Okay.
And then if you're doing development deals, you can do senior debt with what's called CPACE if it's eligible. And CPACE is, it's approved in about 20 markets right now, and that goes in the capital stack. So a lot of developers use CPACE because it's like pref equity. It requires the developer to come in with less money. So that's why they put CPACE. It incentivizes, it's a state approved. So in like California, for example, you can do CPACE. So let's just say I'm building a $20 million apartment. I get 65 or 70% LTC, which is loan to cost from the bank. And then I get in the capital stack, I put CPACE for maybe 15 or 18% of the total project cost. And now the sponsor only has to come in with a lot smaller margin. So the CPACE, what it's really designed for is for the good of the world and the environment, because CPACE financing finances green eligible items like LED lighting and certain foundations and energy efficiencies essentially. But developers like it too, because it means less capital raise and less equity into the deal, which usually means higher ROI for the investors. So there's all these components. So pref equity comes in typically when you're getting some senior financing, but you're short and you're not going to raise it through a syndication. You sometimes will bring in a pref equity piece, which is these large conglomerate companies that come in and they'll take a share of, it could be in the form of debt or equity, or a combination of both. So there's also, in certain areas, there's new market tax credits, there's historic tax credits. There's a lot of ways that on these bigger projects, you're able to get the financing structured, what we call the total capital stack, the capital stack of the deal: senior debt, junior debt, tax credits, CPAs potentially. So you can really structure this, and that's what the really experienced ground up developers start doing, is they piece these financing capital injections together to create a high leverage financing package.
Awesome. Thank you. You talk about HUD. The hikes in rates right now, HUD is much better, I would say. So can you elaborate more about HUD financing?
Yeah, so HUD advantages are fixed rate, 35-year amortization. On construction projects, it's 40 years. So, and the rate's fixed for the whole time. So it's not like a 5-year fixed amortized over 35. It's like a straight 35-year fixed rate. So back in the lowest points, you could close these deals in the high twos. That was, many moons ago now, but the point is, HUD is very good for A lot of developers use HUD for construction projects because you can't beat the financing.
No.
The downside of it is you got to be experienced developer, and also they use, like when you're building these ground up projects, they use it's called Davis-Bacon Prevailing Wage Act. So in high cost markets, HUD doesn't work really well for ground up construction projects. So there's all these caveats, but for most developers in like kind of the Midwest markets, the lower cost areas, HUD seems to work very well. And where else can you get, 40-year amortization fixed at, better rates than market?
Yeah.
And you can only take two distributions, two annual distributions a year. So if you're syndicating a deal, you can't pay your investors quarterly. There's annual reporting that's required with HUD. So it's a lot more labor intensive, but it does fill the void in certain instances. You can do very high leverage financing. There is also even higher leverage financing if you're doing affordable housing. You can work in tax credits. So that's why a lot of the larger kind of affordable housing projects or, certain markets make more sense for HUD. So it really depends on the deal. But I would say it's not the best product that's going to work for somebody that doesn't have experience. You have to be an experienced developer, I think, for it to really work for you well.
Okay. Great. Awesome. And that leads me to the next question about in terms of financing right now. We all know what's out there in the capital market. What makes sense in apartment investing right now for apartment investors? Ground up development projects or cash value add projects?
Right now, I'd say value add projects. I would say there's a lot of people that are got in over their heads.
Okay.
Case in point, I had a colleague friend who invested as a limited partner in a deal, and he thought the sponsor had a lot more experience, but mismanaged, and now he's in a bad position because he put up, $1.7 million of his own money. So those type of deals, he can fix the problem because he's well capitalized, but a lot of people, everybody was a multifamily investor. And, at the end of the day, when the market changes and people were underwriting their bridge debt, their takeout, right? They went into bridge money thinking they're going to, do a big value add and then refinance into 4% money. And now money is 6.5 or 7. That's a big difference for your underwriting calculation. So I think there'll be there'll be a good amount of broken projects that will be picked up by investors, whether it's they come in as an equity injection portion and take over a larger portion of equity ownership of that project, or they completely buy it outright. The foreclosure, I think you're going to see a lot of these bridge lenders foreclosing and an opportunity to buy these foreclosed properties. I mean, it's not going to be a tsunami, but I think there's going to be a good amount to cherry pick. So I think you're going to go from a seller's market to a more of a buyer's market in the multifamily space. And there'll be opportunities for those that are looking for them. I think there'll be, in the next 12 to 24 months, there'll be more opportunities than we've seen in the last 3 or 4 or 5 years.
Wow. Wow. So the capital market now, with the hikes in rates and are lenders holding back? You understand because of a lot of that's your niche. Is lenders holding back right now because of the hikes in rates?
I think multifamily is still a food group or asset class that people want to make, or banks want to make loans to. Yeah. The bridge lenders are out there. There's a lot of capital. So I think if the deal makes sense, it's going to get funded. I mean, if it's a good deal, if the sponsors have experience and underwrote the deal correctly, they'll get funding. It might be a little bit harder to underwrite with higher rates, but if the deal pencils, they're going to get funded. There's always capital. There's always ways to get deals done. So I think there's opportunities to buy stuff with seller financing now too, and or take assumed debt. A lot of people are assuming debt right now as well. So there's always opportunity. It's just learning to be I like the word deal architect. If you're a good deal architect, you can structure deals. Like you can do, you can do none of your own money. You don't necessarily. The beauty of this world is that the only thing that limits you is in here. I could go out today and find a deal where I structure it, where I come out no money out of pocket, whether I'm acquiring a business. Like I do a lot of SBA financing, for example, which is not a product we use for multifamily, but for business acquisition. I can go buy a business with only 5% equity injection. And so I could go buy a cash flowing stream with very little money, but need to know how to orchestrate these deals and then leverage. SBA works very well because a portion of the loan is guaranteed by the federal government. So banks, SBA doesn't make those loans, the banks do, but SBA guarantees a portion of it. So right now, in my mind, even if the market tightens up, the agency products, the government-backed products are still going to make loans. So it's just a matter of what the deal is. So like you can use SBA financing for self-storage, anything that's a business, hospitality, hotels. I'm just buying a business with no real estate. You can use SBA. So I haven't really I've seen a tightening, but it's still, there's hundreds and hundreds of millions of dollars of transactions, if not billions, going on as we speak. There's billions actually.
Yeah.
And that's not gonna change. I mean, what changes is that wealth creation changes. Somebody comes in and buys a deal that once traded at $40 million and buys it for $20 million. And then when the market cycles back, that becomes a $60 million asset that they just completely hit a home run on. So I think there's always opportunities, and I think you just got to be in the position and surround yourself and figure out what's working in this market and then implement those strategies. If you're a small-time investor or getting started, find that 12-unit building, that 12-unit apartment. Go get seller financing. Get high leverage bridge financing, and with a good, clear exit strategy to refinance into long-term debt. And the other thing is there's no I in team, so build a team. What I like about multifamily is that it's more of a team sport. You have the GPs, the LPs, you have the key principal. You put those pieces together, and the sky's the limit. There's nothing you can't do if you know how to harness the power of OPM, other people's money, and creative deal structure.
Awesome. Ton of value. You just had it right. And you made mention of one statement while you were talking. You said deal architect. I believe that structuring of a deal, being able to be innovative in terms of creating deal structure. Can you elaborate more about that?
Okay. So let's say I was buying a self-storage facility, okay? And I'm using SBA financing. Okay. On a business acquisition, I can get up to 90% of the total project cost financed from the bank via a SBA 7A or an SBA 504. They're two different SBA products. Okay. So I'm going to use this as a 7A. I'm buying this self-storage facility for $2 million, right? So that means I need to bring in 10% of that $2 million. And when we talk SBA, we're talking total project cost. So it's acquisition prices, any CapEx, working capital, that can be all financed. So the total project cost is $2 million. So I need to bring in 10%. 10% of $2 million is $200,000. I don't have the $200,000. I asked the seller, will you leave 5% on standby? Meaning, it's like a seller carry, except they can't get monthly payments. It can accrue interest. They're essentially leaving 5% of their equity in the deal. Now I have to come in with $100,000 to close this deal. I'm buying this 100-unit self-storage facility for $2 million. I'm getting the seller to carry back 5% on standby. So now I need $100,000. I go to you and I say, listen, I want you to own 19% of this self-storage facility. You come in with $100,000 and you're an equity partner. You don't have to go on the loan and you don't have to guarantee the loan. You become 19% owner of this self-storage facility. It gets underwritten, it gets approved. We close. I came in with none of my money. I own 81% of this self-storage unit facility.
Wow.
That's a little bit of deal architecture.
Wow.
You can do that for seller financing. You can do that with equity partners, OPM. You put it all together. And then, the goal is, like karate, right? You have belt system. You start with a white belt, blue belt, purple, brown, black.
Mm-hmm. And you
the
scale
goal
up.
for right. The goal is for everybody to become a black belt in deal architecture. Once you're a black belt in deal architect, you can go in a deal and figure out how to solve the problem and create a bunch of money for yourself and for your partners. So that's the most important thing to do. There's a problem here. How can I solve this problem and benefit from this problem that I'm solving? Yeah,
being a problem solver when it comes to deal architecting. Ton of value. Yeah. So what can you say best practices for apartment investors to make sure that they get funded for their projects? I'm sure you've done that over the years that, you've come out to maybe 10 steps, 12 steps of working with investors that, this is the best way you guys can come up with.
Yeah. So I think the important thing is if it's not going to be your capital as the equity injection into the project, is you need to, create a credibility package. You have to be marketing for investors always, maybe not deal specific because you don't have a syndication yet and you can't be, right. You got to follow syndication rules. But you're building a base of investors and joint venture partners. And then you're developing your underwriting skills yourself. So you learn from a mentor, and whether that's online or in person, you constantly educate yourself on how to underwrite these deals and get good on some kind of spreadsheet analyze deal tool.
Okay.
So now you have an investor base. You're really good at underwriting deals. Where you have the right partners that are good at doing this. It doesn't have to be you. You could be good at delegating and get the right people. And then you have, your information on point. You have a really detailed financial statement. You have a bio or resume about yourself. Hey, here's my experience. This is what I've done professionally. I've been in IT sales my whole life. I own, 300-unit buildings as a limited partner. I own, X as a general partner. Your personal financial statement on point, and then just getting the basics of the financials, and then being able to do a 5-year pro forma of when we acquire it, this is what it's going to look like when we lease it up and do our CapEx improvement, and having that ready to go and the financials on the property. That's it. It's not really rocket science. If you do that very well. Yeah. And can orchestrate that, and then also maybe if it's understand the demographics of the market you're buying in, so you can provide information about that to the broker or banker working on the deal. If it's a smaller market, hey, there's a lot of job growth here, and this is why we're buying here, and this is what our value add play is. But it's not. There's no secret to it, really, right? It's just assembling the team.
Okay.
And having it all ready. Where I think people lack is I'll get calls where somebody's like, hey, I want to try to buy this 200-unit apartment building. Do you own any real estate? No. I'm like, well, it's kind of hard to do. Can it be done? Yes, but you have to do this deal architecture stuff where I already have my, my partners and so forth. And that's why sometimes for me, I'm not going to be the operator. But where you could supercharge results is you could become you could do like a fund of a fund, or be a co-GP, a co-general partner. So it's also, how do I supercharge my results? So let's just say let's say I join, I become friends with a very experienced syndicator by networking. He or she knows that I already have a list of investors that I could probably bring into deals. I then become a fund of a fund or a co-GP in the deal, legally in the LLC and all this stuff that you have to do legally to raise capital. So you do that all the right way. Mm-hmm. And so I go from not owning any multifamily to now I'm a co-GP, a co-general partner in a 300 unit building, right? So I just built my credibility. So there's different ways of navigating, right? Like that's what I call a supercharged way of me becoming a GP on a 300 unit property with no experience. And it can be done like that. And then keep doing that, replicate, right? So there's people that all they do is raise money and they're not the actual operators of the other way of doing it is bootstrapping it. I go and buy my first, let's just say I have a ton of duplexes and fourplex, but no commercial. Okay, I go, okay, well, I need to do commercial deals. So I need to do 5 units plus. I go out and find an 8 unit building. I get bridge financing and I refi it with a bank when I stabilize it. And then I buy a 15 unit building. I call that the stacking stone method, right? It's going to take longer, but you don't have to worry about raising money. You're doing it yourself, stacking. So it just depends on where you want to go. You can do any of these, if you think big, you can go out and become a GP in a 500 unit deal. And that was your first deal. So it really depends on how big you think, right? And that's the only thing that's going to hold you back in this business, because there's plenty of educators out there. There's plenty of multifamily training and knowledge base, but then it just really comes down to taking action.
Taking action. Awesome. Ton of valuable today. You've really had it. A lot of perspective when it comes to financing deals and also to getting into the thick of things that we talked about today. How can people get in contact with you? I know you also have a wonderful podcast, Investor Financing Podcast, also to talk about some other aspects of things that people can really reach out to you and be able to have you be in service with you.
Sure, great. Thank you so much. You can go to investorfinancing.tv, investorfinancing.tv. That'll take you to my YouTube channel. Hit subscribe. You can watch videos on multifamily financing, SBA, DSCR loans, fix and flip loans, anything financing, business or investor there. So investorfinancing.tv. And if you want to schedule a 15-minute call to talk to about a deal you have under contract, or how to get started with the financing, you can go to bookwithbeau.com. That's bookwithbeau, BEAU.com. And that's it.
Awesome. Ton of value today. Like I said, we always bring value to the table here in Commercial Property Club Podcast. Today, we've been speaking to Beau Eckstein, and he's added a ton of value to us today when it comes to mortgage advisory aspect of things, financing your deals, apartments, your income properties out there. Also, Beau talked about the aspect of businesses, also to acquiring businesses, which was an additional nugget out there, additional value of knowledge out there. Beau, thank you so much for joining us today. It's been a wonderful moment of great value. So thank you. We hope to have you some other time also to Beau. So with this, I caption today's episode, another pod chapter here in Commercial Property Club. Thank you for joining us once again. It's another time. My name is Olaibiwoye, host of Commercial Property Club podcast. I will see you another time. Thank you.